Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer. So thankful you gave us a few minutes of your time. Also have Andrew Thrasher, Chartered Market Technician and Portfolio Manager. Here we are after Memorial Day and ready to keep on rocking through the summer. Got several topics to hit with you this week, a couple on housing and then diving into technicals. So I'll kind of hit the housing, which lies in the economic and fundamental camp, and then Andrew will update us on current market conditions and a couple of technical indicators that he sent over and covered for the investment team. So let's just dive right in, Andrew, and I'll let you pick it up here after the housing stats. But the first is really what many have felt, and what we see is the monthly mortgage payment has had two different impacts, both causing this affordability to go straight vertical. You've seen housing prices go up and you saw mortgage rates go up. So both those have had the impact of having mortgage payments go up. I think we all know that intuitively, but when you see it in the chart, it sure catches your eye. And on some level, I think we all get that that's just an unsustainable path. And at some point in time has to have an impact on housing. Maybe not everywhere, maybe not on all types. There can be a difference between vacation homes and first-time home buyers and different sizes. But on some level, there shall be some impact. And that leads us into the next chart, where we're really starting to finally see some drops and some roll-offs in mortgage applications. So this can be often a leading indicator. If you're seeing a lot of people apply for homes, that can spill over and keep demand high. One notable impact is traditionally when interest rates first spike, there can be a lag as a lot of people rush forward with mortgage applications as they try to lock in low rates that are well forecasted by the Fed. So there's an initial rush, but after that kind of faded, we can see we're left with a decline in mortgage apps. So whether or not housing follows suit, which has been remarkably strong, even though we've seen interest rates go up, we have still seen the housing market stay relatively strong. So we'll be very interested to see if the decline in mortgage apps has a spillover impact to actual demand and a decrease in housing starts and so on and so forth. So many implications out there, and that we'll have our eye on one of the biggest sectors in the United States. So Andrew, you can feel free to add anything you do to housing. If not, I'll ask you to dive in and kind of take over, talk about the new highs and lows and how that might or might not have changed with the market rebound we've seen.
Yeah, I think we can kind of just dive right into it. Last week we had stocks had a nice little relief rally. We were coming into last week, the market had been down most of the major indices, but for 7 straight weeks. So seeing a kind of a relief bounce wasn't the biggest surprise of the week. Here we can see that typically we do have stocks that have made a lot of new lows. On the top panel there, we have the percent of the S&P 500 that's made a new 6-month low. And then the bottom part is the stocks that have made a number of 12 months low. So a lot of the market has already made a new low. About half of the market's already made a new 52-week low, 12-month low. And historically, when we get to this point where a lot of stocks have already hit that threshold, we start to see market either take a bounce, or more recently, we've seen actually just a straight bottoming out of the market. So historically, like you can see here, typically in the 2000s, we saw a relief rally about 20%. Early on in the financial crisis, it was a 12% bounce. Then if we continue on over the last several years, a 10% bounce. And then after in 2016, the market actually bottomed and went higher. And then 2018, we saw the market bottom and go higher. The two distinctions when the ones where the market really just started to rip higher, like in 2018, it was somewhat of a Fed-induced rally. The Fed had begun to tightening interest rates going into 2018. And then the market kind of started to freak out in 2018 that the Fed was going to be even more aggressive. And we saw that 20% decline, roughly 20% decline. And then the Fed came out and said, you know what, we'll maybe not be as aggressive. And we'll continue to support the market. And then equity traders began to get more bullish again. And so we're in a little bit different environment now, where the Fed is very much focused on trying to tighten policy, try to fight inflation. And so if they were to come out, it would be very bullish, but it'd also be very surprising if they did come out and say, you know what, maybe we won't be as aggressive, just because they've been so vocal in trying to fight inflation. But the moral of this story for this chart is typically we do start to see the markets bounce or get these relief rallies at this point. If we want to go to the next chart, one of the things that we look for, and one of the we get asked from a lot of the families we work with and from advisors, is what do you look for how do you know the coast is clear and it's time to get back in equities, that it's time to be risk on? And something as a technician that I look for is something called a breadth thrust. We often talk about breadth in our allocation meetings. We do it on this weekly video as well. That the breadth is simply a measure of participation. How many stocks are going up? How many stocks are going down? At the end of the day, the stock market truly is a market of individual stocks. And so historically, when we go back in history and we look at when the market finally does have its eventual bottom, that we see these very strong periods of market performance. And so there's many different ways that we look at breadth thrusts. I was going to share just one that's starting to develop now. We're not quite there yet, but it's kind of put in the first step that we'd like to see, is just looking at the number of stocks that are making new 6-month highs minus the number of making new 6-month lows. We want to see this number get very, very low. We check that box. That's the first step. And next, we want to see it get very, very high, get up to 80%. And you can see there the green bars show when that's happened in the past, when we go from a very, very low level of breadth, a very low level of bullishness, to a very high level of bullishness, all within a 35-day period. Historically, when that happens, it occurs right after the market's seen a bottom. We saw it after the COVID crash. We saw it after 2018. 2016, after the financial crisis in 2009, going all the way back to after the dot-com bubble in 2002. And so after these very large declines in the equity market, when we see these breadth thrusts, that tells us the market is strong. It's something we don't typically see just in a counter trend rally. So again, we're not quite there to signify that we have seen this breadth thrust. We're keeping a very close eye on it. At this point, we can just say so far right now, we do believe that this current uprise, the 6-7% we got last week, could very much just be a counter trend rally. But if we do start seeing these breadth thrusts, start seeing this really strong bullish activity, then that's going to be what gives us the confidence to maybe say, okay, maybe we can start increasing some of our risk exposure, start looking at more equity opportunities. But we're very dialed into what the data is telling us. And so when we get that, we'll be making changes, but we want to start getting the weight of the evidence to be bullish before we start making those adjustments.
Andrew, just one question. That was very helpful for me to hear too. I mean, sometimes it's things I know intuitively, and I hear you speaking, but hearing you say it again, it just adds confidence into the level of detail you're looking at. So that's a pretty lengthy chart. Can you give us some sort of idea on how long it takes for breadth thrust to emerge? It's kind of a lengthy there. It's hard to isolate exactly the time frame we'd be looking at.
They happen pretty quick. Traditionally, to get the market to bottom, this specific one was looking for it to be very, very low, very bad breadth, and then within 35 days, it becomes very, very strong. And so that's typically something that happens not necessarily right at the bottom. The market typically will bottom, and then the next couple of weeks, you'll start seeing these thrusts, where the other ones that we look for, where you have 90% of the market go all up in the single day, where you start seeing a lot of people that had shed all their equity exposure, they had maybe panicked and gone on to cash, or they'd gone into bonds or whatnot. And now they're finally saying, you know what, this is when we want to buy, and they all start doing it all at once. Again, what I'm measuring for the market is supply demand. And we start seeing a lot of demand for equities, and they all happen kind of in the same kind of couple days. That's telling us that there's more buyers overwhelming sellers, and that's starting to give us the signs that the coast is clear and the market can start to rally. Because typically you don't see that level of confidence happen in just a matter of days against each other when it's just a counter trend rally. You didn't see those types of activity during the financial crisis or during the dot-com period. It wasn't until the final low to where everyone had left the market, and they all finally tried to rush back in when they started to see equity start to strengthen. So again, we're not there yet. We haven't completed the thrust, but we've checked that first box of needing to see really low levels. We saw that. Now we need to start seeing a lot of strength, a lot of buying. We started to get a little bit of it last week, but not enough to check both boxes.
That's very helpful to hear, and I hope our audience agrees with that. I mean, we'll always shoot it straight and give you the actual. We're not going to just fill you with over optimism or over pessimism. We'll just tell you the facts as they present and what we're looking at, and We don't know how that will develop. Hopefully it develops to the positive side, but time will tell. We have one more little piece to go over. The energy markets continue to be a big piece of how we unfold here. So Andrew, you have one more thing in terms of the inventory. There is just one more facade perhaps of supply challenges we've had. So tell us what we're looking at here on the energy storage across the country.
Yeah, so commodities have been something we've talked a lot about this year, specifically energy. And energy has been one of our sector overweights several times throughout this year so far. And what we're continuing to see is oil prices are going back up. We're seeing oil was strong today, as we're starting to see that Europe is now starting to try to ban some of the Russian imports. That's causing oil prices to shoot up. But when we look at not just on the demand side, but the supply as well, here we're looking at a chart of the storage for crude, gasoline, distillate, and jet fuel. And you can see on that green line is this year. You can see it's a lot lower than the other lines, the other year lines being prior years, that we're seeing a smaller amount of storage of these commodities, saying that we don't have necessarily a lot of supply left to meet what could be a potentially growing demand. And this is going to put continued pressure on energy prices to be higher. Saw another report over the weekend that we could see this summer electric bills could go up 30-40% because natural gas prices are higher and just general electricity is a lot higher compared to last year. And so that's going to continue to put some pressure on areas that like Florida, California, where it gets really hot. It's hard to turn that air conditioner off when it's 100 degrees outside. And so the fact that we're seeing lower storage levels in a lot of the energy markets suggests that we could continue to see higher than normal level of oil prices, natural gas prices, just kind of energy in general could continue to stay, unfortunately, higher than we'd like.
Very well. Well, that's gives us another sector to focus on and potentially continue to ride as we have. Help offset some of the weakness in other areas. But we'll see
Right.
how that unfolds. But thank you all so much. And don't forget you got an opportunity to give us a call to schedule a meeting, 800-928-4001, or scan the QR code, take you to our website to schedule that for you. And also don't forget we have a weekly radio show that you can hear over the airwaves on WIBC or through podcasts, however you tend to get yours. So thanks again and have a great weekend.